There's a lot about this, but that's
Vijay, Vijay.
Sir, Ranshu sir, 2 more years experience. Everybody gets good.
Limit pani sorry po.
You, Pavi. Vandana, send us, those who are going to send, get down. They are calling for pictures. Can you go take their laptop?
Doctor, students request you all please maintain silence and decorum.
Vijay.
Second, hello. Yeah. 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 Settle down quickly. Bhuvaneshwari, you're that or sitting? Sit on that. Leave this thing. Sit on this. Hello. Space there for that side. Go from that side. Here's a full space.
Vijay.
this makes us.
Go directly.
A very good afternoon, everyone. This is Professor Bovina here, along with Dr. Shikha Ahuja. On behalf of IFM institutions, I extend a very warm welcome to our distinguished guests and panelists. I also welcome the Director, IFM College, Dr. Arun Kumar B, Principal, IFM College, Dr. A.M. Shaktivel, Deans and Program Chairs, Principal, Law School, Dr. Ashwini Patro, faculty members, students, and participants. We're delighted to host today's expert panel discussion, Fiscal Choices, Economic Future, Decoding the Union Budget 2026-27. The Union Budget is not merely a financial document. It reflects priorities, shapes policies, direction, and influences the everyday economic realities. Today, we have the privilege of understanding its deeper implications through the insights of an eminent panel of experts. A very warm welcome once again. We are honored to welcome our distinguished speakers of the day. Professor Vinod Vyas, Dr. G. Madhavan Kuti, C. Vinay Mehta, and C. Shruti Agrawal. We request Honorable Director and Principal, sir, to kindly welcome our guests with a small token of appreciation. Please come to the dais. So Vinod Vyasulu, I request the director and principal to kindly welcome him with a small token of appreciation. Dr. G. Madhavan Kuti. Mr. C. A. Nilay Mehta. And C. A. Shruti Agrawal. Thank you, director and principal. Now, let me quickly introduce our panelists for the day. Professor Vinod Vyas is a distinguished economist and public policy thinker with deep expertise in development economics, public finance, and governance. Educated at St. Stephen's College, the Delhi School of Economics, and the University of Florida, he has served at IIM Bangalore, RBI Chair Professor at IISc Bangalore and IPE Hyderabad, and founded the Center for Budget and Policy Studies. Widely known for his work on fiscal federalism, decentralization, and inclusive development. He has been a mentor, advisor, and institutional builder across academia, government, and international agencies. We welcome you, sir. Let me take this privilege to introduce you all to our eminent panelist, Dr. G. Madhavan Kuti, Chief Economist of Canara Bank. He brings over 2 decades of experience across economic research, banking, and the corporate sector. He has previously worked with the Bank of India, the Aditya Birla Group, and the Times Group. At Canara Bank, he provides strategic insights on domestic and global economic trends, monetary policy, and financial strategies, guiding the institution through a dynamic economic landscape. We look forward to hearing your insights. C.A. Nilay Mehta, sir, is a director with Deloitte Haskins and Sales LLP, specializing in mergers and acquisition tax, international taxation, and regulatory advisory. A commerce graduate from the University of Calcutta and a qualified chartered accountant, he has previously worked with EY and PwC, with extensive experience advising multinational and Indian clients across sectors. He is also a regular speaker at ICAI events and is known for his expertise in complex structuring and cross-border tax strategies. We welcome you, sir. We have Ms. Shruti Agarwal, a fellow chartered accountant who has more than 20 years of rich experience in taxation, audition, and financial management. She leads her own practice, Shruti Agarwal and Associates, and is also a visiting faculty at leading management institutes, where she trains postgraduate students like you all in accounting and taxation. She is widely respected for combining professional excellence with strong commitment to financial education. We hope you guys enjoy these sessions with such eminent personalities. Now, to formally commence today's program, it is my privilege to invite Dr. A.V. Arun Kumar, Professor and Director, IFM Institutions, to deliver the opening address. Dr. Arun Kumar is an accomplished economist with extensive experience spanning academia, banking, and financial risk management. He holds a PhD in economics from the Institute of Social and Economic Change, Bangalore, supported by RBI Doctoral Fellowship. His distinguished career includes leadership roles in development banking and commercial banking, including serving as Chief Risk Officer in the banking sector. His research and teaching focus on finance, development policy, banking, sustainable finance, and he continues to contribute actively in economic policy discourse. He has also co-edited a book, Institution and Public Policy for India's Sustainable Development, released in January 2025, published by Reuters and Taylor and Francis London. We request Sir to kindly take over.
Distinguished panelists, my dear students, respected principals, respected faculties, welcome all of you into this budget talk. Recently, Government of India has made a budget of 56 lakh crores. Everyone, every individual is being touched by such decisions. We at IFAI, we need to know and we need to understand what is the implications of this budget on our lives. That is the context in which we are organizing a budget talk. This is very, very critical because these decisions, these policy decisions are the matter of choices. When Government of India decides that I need to spend 5 lakh crores for infra, that's a decision. That has got implications. So there's an implications in terms of priorities, in terms of choices. So that is the context in which we are organizing this as students of business. As students of commerce, we can't be away from that. We need to understand this. Then only our knowledge base will enhance and enrich. So that's the context in which these dialogues, these discussions that we are doing, and this is done, students, basically for you. I request each and every one of you take advantage of the expertise of this eminent panel and try to clarify your doubts. I don't want to come into the way of this eminent panel and you. And then let me just state that I request our eminent economist, Professor Vinod Vyas, to kindly chair this session. And also considering the fact that we have a large number of students, also give them a few practical lessons about budget making. So I'll also request the other three panel members, please share the reflections on the budget. I hope thereafter we have an excellent question and answer session. I assume that these interactions will continue and at the end of the day enrich our understanding about the budget. Thank you very much.
Thank you, Professor Arun Kumar. Understand this is the first time such an event can be organized. Can you hear me?
You just have to bend that mic a little.
Okay, can
Good.
you hear me?
Yes,
Since this is the first time such a discussion is being organized, I thought I'd spend a little time on the background of what our budget is.
sure.
You know that governments come and go. Governments get elected, when they get elected, they make promises. You know, government comes to power and says, we are going to support
Look at
education,
these two
improve
friends, will be all
education,
right.
improve health, things like that. So how do you know that they're actually doing what they're promised to? In order to do anything, you have to spend money. So that's where the budget comes into the picture. The budget is presented in Parliament under Article 112 of the Constitution. Government is required under the Constitution to present a statement of annual accounts to Parliament. That is to say to the country, and said these are the things that we are going to do. And it is that sense that you say that when you analyze the budget, you know whether the government is doing what they have promised. Now, when the government comes to power, they make promises. So then, once you're in office, you make a total, I promise so much for defense, you know, I improve defense, improve schools, improve colleges, improve hospitals, benefit farmers, do all kinds of things. And come up with an estimate of how much money does this require. You did mention 59,000 crores is what the current budget is supposed to be. That is the amount that is needed in order for the government to do the things it has promised. Fair enough. That 59 is not one lump, it's divided into various others. So in the budget, you get details that education, within education, school education, college education, research, within health, how much goes to primary health centers, how much goes to the major hospitals, things like that. Now, in order to do all this, where does the government get the money? The obvious thing is that the government has to raise the money, and it raises it through taxation. So the other side of the budget deals with what are the proposals that the government has made. What kind of taxes will it levy? On whom will it levy taxes? At what rates? And that is the other side of the budget. So what we have is a situation where promises have been made, and in order to make those promises to the people, from the people, we will get the money through a principle system of taxation, and this money will be used to keep our taxes. In this sense, A government is somewhat different from a private company. A private company then starts by saying that, look, we've got equity, we've got so many shareholders, each one is put in a lakh. There are 10 initial investors, we've got 10 lakhs. Now, what can we do with 10 lakhs in order to make up? So there are fundamental differences between government accounting system and the private. The government accounting system has to go from promises that have been made, which are kept. And in a private context, in a company context, you say, look, this is the money I've got. I have to deploy it in business so that I make a profit. There are two different ways of. And this tells you what it is. How do you, where does this information come from? It comes from a set of accounts. Now, set of accounts is apparently a very neutral thing. Saying I've got so much money, I spend so much on salaries, so much on this much. And in order to make all this, I've got so much of income tax, so much GST, so much customs duties, and so on. These are the two things that come out. Now, governments in a democracy, just as they make promises, also have to deal with the people who pay the taxes in a different way. The society is not a society of equals. If we had a society in which everybody had an income of 100 rupees, and you say 1% taxation, everybody paid 1%, the government got the money. That's a system in which everybody paid the same amount, they had the same money goes going. But reality is different. We have people with no money, we've got people with lots of money. So the discipline of public finance has developed. And it said that, look, the only fair thing is that those with a larger amount of money pay a larger amount. In other words, I got 100 rupees, I don't pay any tax because that's considered too low. I get 200 rupees, then on the incremental 100 over 100, I pay 2%. So my tax rate is too much. But somebody has got 10,000 rupees. Now that is very much higher than 100 rupees that they have. So those people will pay say 20% of the top. This is called a system of progressive taxation. The higher your income, the higher the rate that you pay at the highest salary. And this is the way direct taxation works. India has its own system in which I think up to about 12 lakhs you don't have to pay tax. And after that, the system comes up where those who have, I think, at the current rate about 20 lakhs or something. Anyone who's got an annual income, taxable income of 30 lakhs, begins to pay 30% of that. 30%. That's companies. Individuals pay.
Yeah, 30% above 24 lakhs.
About 20%. That's the highest service 20. But the thing is that I might have 25 lakhs and I pay 20. I might have 100 crores and I still pay 20. So it's progressive up to a point. It's not progressive beyond. And this is a policy decision that more details of this will come from my colleagues on the panel who deal with direct taxes and the impact of that direct taxes on citizens, on businesses, on the economy. The other point that I want to make is that governments are accountable. When they spend money, you want to make sure that the money has been properly spent. For this, there is a system in the Constitution for an audit of the accounts. There is an independent office called the Comptroller and Auditor General, whose job it is to look at government accounts, scrutinize them from any point of view that performance budgeting, efficiency budgeting, whatever it is that they want to. They look at it, they write reports. And these are periodically given. Practice of the CAG is to present the reports to the President of India, and the President of India places them in Parliament. In Parliament, they are scrutinized by a committee called the Public Accounts Committee. In the past, the Public Accounts Committee was always chaired by a member of Parliament from the opposition party. That practice doesn't necessarily work. But that committee scrutinizes it, makes recommendations, and these are discussed in Parliament. And very often you say, look, You said you would build a metro. You said you'd do it for 1,000 crores, it's got 1,200. You are inefficient and a discussion goes. But the system of auditing the account for purpose of accountability is built into it. Over the years, some problems have happened with it. There's the political process. Because the nature of the budgeting that we do is such that the last budget that was presented by Finance Minister Nirmala Sitharaman has 3 columns. One column is what she says, the money that I allocate, intend to spend on different things in the coming year. The next column says that last year I promised to spend on hospitals so much, but I've actually spent this much. So if she promised to spend 100 crores and she spent 101 crores, then that is what is called a revised list. First is the intention. This is what I intend to spend. The second is a revised estimate of last year I intended to spend it, but this is what I've actually. And the third column is that from 2 years ago, the audited accounts have come, and if I promise to spend 100 on them, it shows that I spent 101 and that is. So this is the overall system. Now what happens in that is the audit takes time. And for the audit to be fair, when you find an objection, you have to clarify to the person spending money. So if in this case of hospitals, the government has set up a lanes. And there was some overspending. There could be very legitimate reasons for it, in the sense that the prices have gone up from the time the government made this. And therefore, what you wanted to buy 100 crores now costs 105, and therefore. So these kind of things take time, but when the auditor says that you've overspent, you have to go back to those who actually implemented the project, find out their reasons. You might say the reasons are good and accepted, you might say the reasons are not acceptable or not acceptable. And with your comments, you send it on. But this process takes time. So what happens is that the Public Accounts Committee in Parliament gets reports that are 2 or 3 years out. And then with the delays in Parliament, discussions take place. So the accountability system is in place, but it doesn't in practice work very well because of these practical. There is another aspect to the budget. In India, direct taxes, which are the main source of revenue, are collected by the government of India. But the expenditure under the constitutional scheme takes place not only with the government of India, but with the states. So there is a mechanism in the governmental system and in the budget, saying that the direct taxes that the government collects have to be shared between the government of India and the government of the very states there. How is this to be done? For this, the constitution provides an institution called the Finance Commission. What the Finance Commission does is make an estimate for the next 5 years. And say that the government is expected to collect this amount of tax, and this is the wages. And the sharing has 2 parts. How much does the government of India get from that total fee? How much do the states get? So the latest Finance Commission, the 16th Finance Commission, has recommended that 41% of what is collected should go to the states. Now, 41% collected goes to all the states taken. How much does any state, how much does Karnataka do? How much does Maharashtra do? How much does Tamil Nadu do? There is also a formula within the Finance Commission based on different criteria. And different finance commissions have used different criteria. So that based on that formula, we say of the 41% that is available, 6% goes to Karnataka, 8% so and so on. In the past, what has happened is that because of the uneven development within the country, the states that were less developed, which were largely in the north, Uttar Pradesh, Madhya Pradesh, Bihar, they got a larger share because they had to spend more money to catch. But as you can understand, when a state gets less, there's a consequence. The states are constantly growing. Whatever the award of the Finance Commission, Some states will feel they're unfriendly. This part of the political process, you have to. The union budget will just say that so much is allotted. Of the amount with it then talks about what is spending. On the other side, how is money spent? Each ministry prepares what it means for the promises made. This amount is then put into a document which is called the demand for grants. And it is one side of the budget, it goes, no money from the consolidated fund of India can be spent without the approval of parliament. That approval is to present a bill, it's called an appropriation bill, and once it is passed, then you can spend the money. So this is the process by which, and there are very detailed information on what each ministry gets. And similarly, there is such a situation for the states. Each state has a budget and such processes exist. There's only one last point I want to make. In the early 90s, government passed the 73rd and 74th amendments to the Constitution. These created what are called local self-governments, like Greater Bangalore Authority here, the Mysore Corporation, the Delhi Corporation, Bombay, Raichur, all of these cities. And then at the local level, villages, village panchayats. We still use the old term from ancient India, the panchayat. But this is not the traditional caste panchayat, this is an elected one. So, after these amendments, a part of the money that goes to the states is further sent down to these municipalities and panchayats for spending there. And a similar process of account. So this is the overall context of the budget. The Government of India budget will talk larger about what the union government under the Prime Minister's government of the taxes it has collected and the expenditures it has decided to do. On this, we have a panel which will discuss it. Mr. Mehta will talk about the direct taxes and the implications of that from this year's budget, so that you can. And Shurya Agrawal will talk about the indirect taxes, the GST, and how it works. She'll also explain the system by which it's came into being that system. Then Dr. Madhavan Putty will discuss the impact of the proposals of the government onto the banking sector and the. So if you have any questions, please write them down. If there's time, we'll be happy to answer them. Now I call on Sonia.
Thank you all. I have future entrepreneurs in front of me, and it's pleasure to speak in front of you. I only need 15 minutes from you all. In that 15 minutes, I need participation from you as well as attention. I will be discussing few nuanced topics in the direct tax budget, and how you can apply in your life. Just give me a second.
Yes.
You projected here?
So,
We can see this.
You can see.
You can see.
So maybe I'll start with something about myself. I'm born in Toronto in Canada, moved to Bangalore. My background is my family. I like simplifying things, automating things. Hello. Yeah. I like simplifying things, automating things, automating repetitive tasks, and this is something that should stay with you guys. How to make complex things simple, how to automate tasks, how to save your time. Last, obviously, I like winning cricket and enthusiastic. Been in Deloitte for more than 3 years. Earlier, I was in EY, PwC. I have served clients across industry. In the next, before we move into the direct tax proposals, the two emerging themes on the budget, and which I think the Modi ji is trying to cultivate in all of us is first important is Make in India. So if you see the overall theme in this budget, which has very minimal amendments, rightly so because there's a new income tax act going to come. One of the key themes was fiscal prudence. He told that we have maintained fiscal deficit below 4.5, which means that we are marginally exceeding our expenses and income. He nicely put that our debt to GDP ratio is 55.6%. If I have to read it underline, the debt is quite high now. Generally, debt is never compared to GDP. This is first time the Modi ji has compared debt with GDP. And obviously, the last thing, or the given the market dynamics, we are a stable economy. We are looking for a growth, and that dynamics is also improved. The second important message that he gave to the world or to the Indian entrepreneurs, future entrepreneurs, is you guys, is now doing business. He has amended the law. For example, let's say if you are doing a business or that is doing a business and it's a demand, the earlier the requirement was 20% of the demand had to be paid. He has reduced to 10%. Even under the Income Tax Act law and various other laws, the penalty provisions are there. Plus, there are prosecution consequences as well. He has defined that, which is now no prosecution for tax issues. Yeah. Okay. And the last is dispute prevention. So if you guys are following India as a land of dispute, be it legal or tax, the litigation goes on. So if you speak to any MNCs, they are afraid of coming to India. The only reason is that for 1 year they will be faced with litigation for at least 10 to 12 years. So the image of image of India had to be changed. Litigation had to be reduced. There's a lot of backlog, and I think there are certain amendments in the act which helps in create this ring-fencing future litigation. And the last part is macro structural stability. Obviously, he has invited capital from Indian diaspora, which means NRIs can now invest more. He has increased the limit. The PU, the public sector limit, there is a recycling, REIT, etc. Those are the good initiatives from the capital market standpoint. Now comes the key tips from driving M&A standpoint, because M&A is my core area. Obviously, the capex at scale helps create deal momentum among private equity. Given the fact that we are moving towards an economy which has more certainty in terms of tax, reduced litigation, less penalty, it helps in building confidence among investors, attracting new investors, etc. And few decisions on the sectors like AI, data center, as well as rare earth mineral, etc. That actually makes India attractive. And while they are little late in these sectors, but it just gives us a runway to move ahead. Now I will, in the next 2 slides, I will be discussing 3 or 4 main amendments. This one is a small one, but the reason I put this as first is because Indian government is quite reactive, quite acceptive. Earlier, few years back, if an Indian company, and if you are trading on stock, you have realized that Infosys, Wipro, they do a lot of buybacks. The buyback was accepted in the hand of the company, exempt for shareholders. So the lot of promoter company used to use as a planning opportunity. And the nuance here was that a listed company, when it does a buyback, or a private company does a buyback, the cost of acquisition is not the cost that the shareholders have acquired, but the funds that company has received the time of primary. That got amended in 25 to say that now buyback is not a capital gain, buyback is a dividend tax. Any cost that you guys have put in subscribing the company, you will not get as a deduction, you will get as a deduction in future capital gain transaction. So company dividend tax. So shift from company tax to dividend tax. And now again, within a year, they have amended to say no, buyback is capital gain tax. Whatever shareholders has paid and whatever is selling at, the difference we will tax at capital gain. Only difference is the tax for promoter company is increased. If you are a domestic promoter company, the effective tax rate comes to 22%. If you are a non-promoter company, that is individual like us, it is 30%. This is something I am honestly not clear whether this is going to help India or not, but we will just talk about it. First time Indian government has announced something on data center. Okay, so what if I have to give you a quick background or just a concept, India generates, obviously because we have a vast population, we generate 20% of the data. However, we do not have even 2% of data centers. What government has done, they have told a foreign company can have a data center services from India. A foreign company, let's say Google, let's say Amazon, can avail data services in India, and all the income that foreign company earns, we are exempting you for up to 47, 31st March 47. However, there are four conditions. First, foreign company should avail data center services from a specified data center. Government will come up with a list of what is specified data center. Uh, you can consume all the data from the Indian data center, but the data center should be owned and operated by Indian company. So it has to be Indian entrepreneur. Either it can be a group entity of the foreign company which can own the data center in India and provide services to foreign company, or it can be a completely third party entrepreneur like you all who provide data center services to foreign company. If the foreign company has to resell or has to provide these services in India, they cannot provide it directly. They have to have a reseller in India. Through reseller, they can provide services in India. So it creates business opportunity for Indian reseller. It creates Indian opportunity for Indian entrepreneurs who are set up a data center. This is in line with Viksit Bharat, but I think Sir actually pointed out that there are certain disadvantages of setting up a data center. It requires land, it also creates uh, pollution, etc. So a lot of other aspects are there. And if the foreign company is going to use the data center, so what is it that we're doing? Are we only going to provide the infrastructure, or are we going to leverage this to build an AI? So that is something that we'll have to see. And by the way, that at least because I'm third, I know that the amendment of data center came because of lobbying by a couple of big players. Even here, there is a lobbying by one of the phone manufacturer. This is electronic tool manufacturing. So here, in last budget, government had already come up with an amendment to say that if you are going to produce any specified goods in India, your effective tax rate will be below 10%. And you can directly, you don't have to maintain your financials. You can come under presumptive taxation rate, and you can 25% of your receipts will be stated as subject to tax, effective tax subject to 10%. Now what government is saying, okay, foreign company, they can provide tools, or they can provide machinery, they can provide Intel, IP, etc. to an Indian manufacturer. Indian manufacturer can produce goods on their behalf. The goods will be in the control and management of Indian manufacturer, but ownership will be with foreign company. So basically, simply saying, let's say Apple wants to produce mobiles, they'll engage Indian manufacturer who will produce mobile on their behalf. Then the foreign manufacturer, Apple US, can sell any part of the country or any part of the world. Okay, only trick is, and it's quite logical, that the manufacturer has to be in custom bonded warehouse. Why custom bonded warehouse? Because if you are in a custom bonded warehouse, anything you import, you don't have to pay import duty. Anything you export, you don't have to pay export duty. So completely free movement of goods. The last and interesting proposal, this is something which will help in reducing litigation, is a safe harbor rule. For example, if an Indian company is providing any services to a foreign company, and generally most of the Indian companies function in cost plus basis. So if I have incurred expense of 100, I will apply a margin of 15 or 20% and say US entity to pay me 120. We call it a transfer pricing arrangement, because not only I should get compensated for the cost that I incurred, but also for the value that I've added. So a lot of litigation in India was there. What should be the markup? 15%, 16%, 20%, or even 22%. Now that gets completely wiped off, because government has told that anything, if you are in the particular sectors, then we will provide for then straight away 15% this thing. Okay. Yeah, straight away 15% and no litigation, which means. So safe harbor is something of welcoming. It's a good move. A lot of GCCs, which is Global Capability Center, are looking to avail this 15% benefit. Lastly, I will touch upon few amendments. I'm sure first amendment you all will be aware of, which is STT. Budget was announced on Sunday, and the market fell only because of this amendment. Because they increased the STT on futures to 0.05 and options to 0.15. I at least personally like this amendment because this will discourage shareholders to trade on options and all. Second was leveraging IFSC. So IFSC is Gift City. I don't know how many of you are aware about the Gift City in Ahmedabad. So government is trying its hardest, trying its best to promote Gift City. Basically, for example, if you know Singapore, Mauritius, they are financial hub. Gift City is also replicating the financial hub. So any key investors or any pooling vehicle which wants to set up its presence, Gift City is a viable option. And now they extend the benefit of no income tax for up to 20 years, which is 20 consecutive years after 25. The third important amendment which we'll have to see, I would say it's a proposal by Sitaraman saying that complete review or detailed review of FDI policies. So currently, any foreign entity coming to India, they have to do a lot of compliance. So if a foreign company invests in India, it's a foreign direct investment. If an Indian company invests outside, it's a overseas direct investment. So currently, all the FDI are closely monitored. There are sectoral caps. For example, service is 100% allowed. Indian company can be 100% owned by a foreign company. But if you are into defense or in strategic sector, then there are sector limitations like 75%, insurance also similar. So the government has proposed to amend. I think a lot of paperwork is involved. If Indian company has to issue shares, you have to file certain forms like form FCGPR, if there's a transfer, FCTRS, and it's quite a complex process. So I'm looking forward to this amendment. What does it mean from India's economic standpoint? The fourth, obviously, is the MAT design. So earlier, currently, most of the companies are at 25.17 tax bracket. Earlier, the tax rate was 30%, and if the companies are claiming deduction under any incentives because of which they're not taxable, then there was an alternative tax, which is MAT, minimum modern tax, which was earlier 18%, reduced to 15%, and now they have reduced to 14%. They have told that if any company wants to go under new regime, then they can claim up to 25% of the MAT credit they have. The last is TCS. The reason I brought, if you guys are applying for education loan, or if you are making a remittance outside India for towards education, then there is additional levy of 5 to 20% earlier. Now that has been reduced to 2%. Similarly, for any overseas tour program, if you reach out to any traveler and say that you want to travel, let's say Dubai, Singapore, and if it exceeds the threshold, then 5% of the TCS was also levied, which will now get reduced to 2%. The last two small ones. First time government has told that we will allow you to file your revised return after initial initiated. But tax officer will ask questions, you will ask, you will give reply. Then you will realize, okay, this is a mistake. You have liberty to accept the mistake, file your revised return with small amount of fine and penalty. And the last, the reason I brought it is because it is important to understand finance, how finance works. If an Indian company borrows funds and invests in listed securities and it receives dividend income, you can't claim deduction of against that income interest expense. The government is saying no deduction for interest expense against dividend income. So it's quite weird, but that's how the government is looking at it. They don't want you to use borrowed funds to invest in equity and earn dividends. Yeah, I think that's it. This is it. I'll hand it over to.
Shruti Agarwal.
Thank you, guys. Thank you.
What are we doing for life? Okay.
First of all, I would like to really thank Assam College for inviting me for the discussion on budget 2026. And it is indeed a privilege for me to be there with such esteemed guests. I would like to bring about a few aspects with respect to the budget. The focus will be on indirect taxes, or taxation as a whole. So if you look at the how the government is now thinking, like earlier, the government, it was focusing on, it was encouraging people to save and invest. So the government wanted you on, then you invest where we are telling, and then you save some tax. Then you utilize the money wherever you want to. But now the shift has focused to earn and spend. Now they are not telling save and invest. They are telling you on, you pay us some tax, we have lowered the tax rates. So you enjoy the tax benefit and then you do whatever you want to do. So you spend it, you invest it, now it is gone. So now why the government has changed its focus? Why is it not emphasizing on save and invest and then on earn and spend? So actually there could be many possible reasons for that. One of them could possibly be, see there's a lot of administrative hassle on the part of the government to check. Suppose if you are making any claim, any HRA or any kind of deduction or exemptions, they have to sit back and check whether the claims of reassessing are correct or not. So it is not that easy, it is expensive, it is time consuming, people make wrong claims. So instead of that, they are telling, no need to make any claims, so they need not sit and check, so they are saving on that expense. Second is, they feel that the tax base for the economy will increase. Somehow, if you see around you the taxpayers, since the new regime has come, people are feeling really happy that at least receiving some amount in the form of taxes. Why? Because they are comparing it with the old regime. So when you compare, you feel happy. Ultimately, money is going to go from your pocket, but you have that sense of savings. So happily, people are ready to pay. And on top of it, if you just start earning, like when you finish your college, so when you just join, it pinches if you have to pay tax. So in the old regime, you have to pay tax if you earn above 5 lakhs, right? But in the new regime, up to 12 lakhs, no tax. So everyone feels very happy that I will earn full 12 lakhs in my pocket without paying any good tax. And if there is a family of two and both are earning 12 lakhs each, zero tax on 24 lakhs, which is quite good, right? So there is a very good feeling in the mind of the common man, the one who is paying the taxes. So the government thinks that over a period they will earn more in the form of revenue, and that again that money they will utilize for the socio-economic causes. So whether it will really happen or not, we will see over the years, but that is what is the plan. And moreover, if you have noticed, then this new Income Tax Act of 2025, it will be implemented from 1st of April 2026. So we will be the people who will be witnessing it, right? The earlier act was 1961, which we are not aware. We have seen the implementation of GST also, we will see the implementation of the new Income Tax Act also, right? Because it will go down in history. We may not realize its importance right now, but definitely it is a very, very big move. Now, moving on to taxation, the indirect tax related aspect. The aim of the government now, the objective of the government is they want to simplify the tariff structure. So that means they accept that it is complicated. So when you're trying to simplify means it is not simple. So first they make it complicated and then they try to simplify it. So first you be very strict and then you try to be less like that. So first they are trying to simplify. Second, they want to promote the domestic production. They want to have export competitiveness. And they want to make our exports very competitive in the international market. Right? Because only then we can earn some foreign currency. And the last objective for indirect taxes is they want to correct the inversion in duty. Now, what is this inversion in duty? I don't know whether you are really aware. This inversion in duty arises when, suppose there is a person who is doing business. When he's selling a product, he's charging a lesser GST rate. And when he buys the raw material for the same product, he's paying a higher GST. So there is an example of a corrugated box that is used for packaging. So you may check it. The GST which is charged on its sale is only 5%. Actually, in the last 56 GST Council meeting, they reduced it from 12% to 5%. So suppose if trader is selling the boxes for 1 lakh, he will charge only 5,000 to the customer. But he has purchased the raw material for that, the craft paper. On that, he is paying 18% GST. So for the same 1 lakh raw material, he has paid 18,000, but he's charging only 5,000. From his pocket, 18 has gone, but he's getting in return only 5. So 13,000 rupees is blocked, right? This problem is there for different products where the output GST is less than the input GST. So they are focusing on making that correction. So they want to make that difference of 5 and 18% less between the input and the output. Definitely they are putting efforts towards that. Now when we talk about indirect taxes, the first thing which comes to our minds is GST. But if you would have observed in the budget, there was hardly any mention of GST. Right? The reason for it is that the GST Council meeting keeps happening. So every quarter there will be a GST Council meeting whenever they want. And it is not necessary that on an annual basis they will bring about any changes. As and when the government wants, there's full power, it can make changes. So last September only in the meeting, they have already brought about huge changes in the GST structure. So now 12% is already gone as we are aware. 5% is for the essentials, 18% is the standard rate, and 40% is for the luxury goods. So that's the reason, and in that meeting only, they have already given certain recommendations. So what has happened in the budget? Those recommendations will now be implemented through the budget. So they will make amendments in the finance bill because what was presented was the finance bill. So in that, now the amendments will be done. That they will specify. Now in the budget, 5 changes were done in GST. So I try to explain in short what all changes. The first one, that is with respect to intermediary services. Now, what is this intermediary services? This change has been brought about in the IGST Act. So, what happens is, if you are an agent, so the agent is in India, he is providing services to a customer who is sitting outside India, as you be sitting in the USA. The agent is working on behalf of a supplier in India, he is providing services outside India. Now, the POS rule is the place of supply. The rule says if you are an agent, in such cases, the place of supply will be the place of supplier, that is the agent. The agent is sitting in India, so place of supply will also be India. Now, when it is India, automatically it will be liable for CGST and GST. Technically, if you see these exporting services, ideally we should not be charged any GST. Why? Because exports are treated as zero rated supplies. So no tax on exports because government wants to promote exports. But he ends up paying 80% tax. Now what they have done, they have changed the POS. They have removed it from agents. So now the place of supply will be the place of recipient who is sitting in the USA. So automatically it will be treated as an export of services. So now this transaction, there will be no GST. So definitely it will make his services more competitive because he will end up saving 18% tax on his services. This was a very big anomaly since the implementation in 2017. But they have still not made it clear whether it will be with retrospective effect, like it's already the previous cases which are going on, or whether it will be from the day they decide, because still the date of implementation has not yet been announced. The second change is with respect to post GST discounts. Now, what happens is the government says if you are selling a product, many times what happens, the seller and the buyer, the seller will tell that if you pay me within a month, I'll give you a cash discount. Now, the GST rule says that you should have an agreement before the sale that after the sale, on what basis will you give the discount, how much discount you will give. So, when the seller is raising an invoice, now again, suppose 1 lakh invoice, he has charged 18% GST. But the customer is not going to pay him 1,18,000, right? He will pay him less. Suppose if he is entitled for the discount, he will end up paying less. So the seller needs to do some adjustment of GST. He could not do it. First, he should have a pre-agreement. And the second condition was your invoice. The seller will raise a credit note to the buyer. So the credit note has to be linked with the invoice. So these 2 conditions were there. Now the government has removed both the conditions. So it is not necessary that before sale itself you should have an agreement. Plus, no need to link your invoice with the credit note. So it will become very easy for them to claim the GST adjustment. But definitely the buyer has to reverse the input tax, but only then he can get the help. The third change is with respect to the conversion of duty which I was talking about, provisional refunds. Currently the rule is if you are an exporter, so like I said on exports there is 0% tax. But to export my product, I will manufacture it. So I will have to spend some money. I will pay GST on my inputs. So what happens to that money? My money is dropped. When I sell, there is no GST. But when I purchase, I paid the GST. So 90% upfront refund actually you can claim. So if you are having 10 lakh as input tax credit, 90%, 9 lakh the government pays you upfront. 10% is paid on the duty. Now the same scheme they have shifted to this inverted duty structure which I was talking about. So this sector, which is having a huge gap between output and input GST, even now they will be entitled, they can claim 90% refund upfront. So whatever money was blocked for working capital, now it will be released. So it is a very welcome move on the part of the government. The fourth change is for export refunds. Earlier, there was a limit of 1,000. 1,000 may appear to be very less, but for very small exporter, see, you have to encourage all the exporters, right? So below 1,000, you could not claim any refund. Now there is no threshold limit for any refund. You can claim any refund, how much ever amount it is. Up to 90% they will give you upfront and 10% they will give you later after scrutinizing your books. The last change is with respect to advanced rulings. Now what happens is every state has an appellate authority for advanced rulings. So if there is any issue between the GST taxpayer, he can approach. Now many times what happens, that each state will have a different decision. Suppose a trader in Karnataka, he goes to the appellate authority, and the Karnataka appellate authority gives a judgment not in favor of the taxpayer, so it is against him. A similar case in a neighboring state, there the judgment is in favor of the taxpayer. Now definitely there is a conflicting rule, so one appellate authority is giving in favor, the other is giving against. So for that, the government had proposed that there will be a national appellate authority, which will be over and above all the state appellate authorities. But that is only on paper, it could never be implemented. So in the budget, she has mentioned that now, whatever the GST Council, if they recommend, then the government will give this authority to any existing authority. So basically the GST appellate tribunal, it is expected that they will take over the National Appellate Authority work. So now you can approach them if there is conflicting views between different cases. So that is again a very welcome news. All the five are actually in favor of the taxpayer. Now the other thing is with respect to the customs duties. So as you would have heard,
Time.
that the government has slashed the customs duty on various products, and they have also reduced they have made certain products duty. So what all has become cheaper and what all costlier. So cheaper is the cancer and rare disease medicines. Then what you will be impacted is the mobile phones, the batteries and all the customs has gone down. Then the microwave ovens, your leather goods, footwear, the electric vehicles and batteries. And one more important thing is your personal use inputs. So suppose if you are getting a laptop from outside, so they have slashed the duty from 20% to 10%. And whatever is becoming costlier will not affect that particular section of the society because it is all the luxury watches, the imported alcohols. So that will not affect a major section of the society. What may affect you is the video games, they will become a little costlier. So that is what may impact you. Now just a few points regarding the education sector. They have also recommended that in association with ICAI, ICSI and ICMI, they will develop short modular courses for students. So once you do those courses, definitely you will be eligible to get more employment. Short-term modular courses, no need to do the entire professional course. So that is again a welcome move. Then as you all know, the ECS on this education, foreign education has been reduced. So up to 10 lakhs if you want to spend abroad on education, as such there was no TCS. And if you take a bank loan, 0 TCS. But if your expense is above 10 lakhs, then definitely you have to pay now 2% TCS instead of 5%. So the money blockage will be less for the person who has to send his kid outside India. Just one last aspect which I want to touch. They have gone very soft on the NRIs, the non-resident Indians in the budget. So can I just speak a few points?
Just.
Yeah. So with respect to the NRIs, suppose if an NRI is selling a property in India, the buyer had to apply for a separate tax deduction account number. So it's a unnecessary applying, right? And then he has to surrender it once the sale is done. Just for one transaction, we had to apply. Now they are done away with that condition. Then one very important thing, the person is resident out of India. So this is one more new concept other than NRIs. All the NRIs are persons resident out of India. They can invest in Indian equity. So earlier the limit was 5%. Now they have increased it to 10%. And the overall investment limit from 10% to 24%. So they have enhanced the limit, which will definitely the individual investors, the people who reside out of India, even they will start investing more in the Indians. And for the visiting NRIs also there is a tax exemption, so if they will work for the government notified schemes, they don't need to pay tax for the first 5 years of their stay in India. So this is for the first time that they have given, or they have become soft on the NRIs. They have also given the foreign asset disclosure option, so you can disclose with very less penalty and prosecution. So all these are very welcome moves on behalf of the government. So basically, if we see, we should have a close eye on the numbers, but we should have a very closer eye on the people whom those numbers represent. So the government is trying very hard. They want to keep everyone happy, even they have to meet the expenses of the economy. They want to keep the common man also happy. They want to keep the tax rates also okay so that people happily pay. But they are not able to collect enough revenues. So it is not that easy on their behalf to manage on this. But if you see, they have been trying very hard so that in the end, they are also able to meet their objectives and the common man also stays happy. With this, I would like to end my discussion.
Dr. Madhavan.
No, this is working, right? Good afternoon, everybody. At the outset, I am thankful to all of you for giving me an opportunity to share my thoughts on salient features of the union budget. Of course, the nuances have already been shared by Dr. Vinod and Mr. Chudi and Mr. Mehta also on the taxation fund and what is the budget, why the budget is important. So these aspects have already been touched upon. I just try to share my perspectives on the takeaways. I mean, how it impacts the economy or how it can impact, how it impacts the banking sector, what are the key takeaways and so on and so forth. So one of the major factors which comes out in the budget is the steady momentum which they have maintained for public capex. So when you say public capex, it means capital expenditure, or for that matter, it means the huge investments which the government is giving for infrastructure. So that means defense, roads, telecom, then waterways, inland waterways, so on and so forth. So under this particular head, the allocation has been increased by 11.5% over the previous year. So when you hear 11.5, you may feel it's not such a big amount, but we have to appreciate it from the point of view of the fact that it has come on a base of 11 lakh crore. So last financial year, I said FY 25-26, the budget estimate was 11 lakh crore. So there is a 10%, there is an 11.5% increase over this 11 lakh crore. It means an additional 1 lakh crore, 1 trillion increase is there for capex. Now, when capex is boosted, what happens is there is a multiplier effect. I'm sure you are familiar with this terminology because at least one paper on macro would be there. So this investment in infrastructure creates a lot of multipliers. So when you invest in infrastructure, it automatically creates jobs. Then it creates income. That will increase the demand. Wages will go up, demand will go up. And when demand goes up, ultimately there is an incentive for the corporates to increase their production. So when you increase public capex means that for the investment by the government. That automatically leads to a condition where private capex can also go. So private capex means the investment in plant and machinery and fixed assets by the private corporates. Why this happens is Because of public efforts, people have more income, they have more work, more production. And when there is income, ultimately, automatically, there is an incentive for the private corporates to produce more. So, the one main reason why public efforts is done is also because it will stimulate the private sector to increase their efforts. It is one major criteria. Secondly, one major number which everybody has talked about and which is important is the borrowing numbers. So, the budget has two types. One is the revenue side and one is the expenditure side. And there's a gap between revenue and expenditure. So, as Dr. Vinod rightly said, about 53 lakh crore is the total expenditure. And the revenue is around 36 and a half lakh crore. So the difference is what is called the budget books, or the fiscal books. Now, how do you bridge that? You bridge that by borrowing. The government borrows. So this particular year, the borrowing numbers are quite high. So last year, they borrowed 14.8 lakh crore. This particular year, the borrowing numbers are around 17.2 lakh crore. Now this high borrowing number has come also because in 26-27 financial year, there is lot of repayments which the government has to do. Typically, in the past couple of years, if you see the amount of the repayments which they had to do was around 3 to 3.5 lakh crore. But coming financial year, FY 26-27, the total repayments which the government has to do is coming to almost 5.5 lakh crore. So that is why to take care of these extra repayments, the government has predicted higher borrowing numbers. And how do they borrow? From where money comes? They borrow because they borrow using banks. Because there are other institutions also, but banks are one of the major investors, major players in the government borrowing program. How do they do this? They do this by investing in securities issued by the government or the bonds issued by the government. And standard terminology for that is these government securities, which is called G-SECs. G-SECs means gilt-edged securities. So there is a small gilt kind of layer that market. That's why you call it G-SECs, gilt-edged securities or government securities. So government wants to borrow 17 lakh crore. They do it by issuing securities or in the financial jargon we call it bond. And banks invest in these bonds. There are other players also, like insurance players and insurance, but banks are biggest players. And how do they invest? The Reserve Bank of India has mandated that banks have to invest 18% of their total deposits in government securities. It's a mandate. So if a bank has 100 rupees deposits, 18 rupees has to go towards government securities. So this is one mechanism how the government is funding this borrowing program. And similarly, insurance companies and mutual funds and to a certain pension funds and all these players also come to it. Now, what are the implications when we say borrowing program is increased? So when borrowing program is increasing, what happens is you need to get more money from the market. So you issue more securities. And when you issue more securities, the interest rates will go up. Why? Because without going into bond dynamics, simple way to understand this. If you want to induce people to invest more in bonds, you have to pay the means. There are other dynamics also. I can say that the bond supply is more, the bond prices come down, and when bond prices come down, there is an inverse relationship between yields and prices. That's a different science. But for simplicity, we can understand that when the borrowing program is high, when the bonds are issued in large numbers, if you want people to invest in your bond, you have to offer a high rate. So for the banking sector implications, the bond yield or the rate of interest for these bonds will go up. And when the rate of interest on the bonds go up, what happens is the price of the bonds come down. So yields going high and prices also going high will not happen. When the yields or the rate of interest on the bonds go up, the prices come down. So it creates a loss for the banks. How? Because suppose you have purchased a bond at 100 rupees and if the yield is going up, what we purchased 100 some time back, that will be valued only at 99.5 or 99 now. So actually you are sitting on a loss. If you are selling it, you will incur an actual loss. If you don't sell it, you are sitting on a notional loss. So the implication for the banking sector is when the borrowing program is increasing, the yield is going up, their bond investments will suffer a notional loss. But if you're holding it in maturity, it's fine. Otherwise, they will suffer a notional loss. Now, third major aspect related to banks is a high level committee has been constituted to study the reforms in the sector. So there's a feeling that, not a feeling actually what is the situation is, if you see the largest bank in India, which is the State Bank of India, it is ranked only 42nd across the world. I mean, it's, I think in Asia, not even the world. Now we need bigger banks. The top 5 or 10 banks are from China, like ICBC, Agricultural Bank of China, all the top 5 banks are from China. Then you will have a question actually, why do we need bigger banks? We need bigger banks because if you want to fund the large scale funds, we need the wherewithal to fund large scale projects. For that, we need banks with a bigger balance sheet size. So how to do that? These are the 5 points which are going to be discussed in the course of time. And for that, they have identified, they have not identified, they have thinking or they have already constituted a high level committee. And the council locals really should come within a month or so. This is important because if India has to be seen as a major player in the global stage, we need to fund projects outside India also. So imagine this, why you feel that China is going to fund this Belt and Road Initiative, they're funding a lot of projects in other countries also. Venezuela they have, Nigeria they have. Also the African countries are in a way colonized by China because they are able to fund to BRI projects. If you consider India also wants to have a standing rights. If we want standing in the global stage, if we want to be a powerful player, then we need to have an institutional setup which is very strong, which can have the wherewithal to have influence on the global stage. So one, it can come with diplomacy, the way we are doing now. It can also come with a sheer muscle power by way of the institutions in the domestic economy with sound value chains. This is also one major criteria why we should have bigger banks. Of course, the domestic requirements are also there. Recent Bharat 2047 is there. So we need steady economic growth at the rate of 8% per annum. So we need stronger and bigger banks. Then again, in fact, most of the announcements in budget are one way or the other related bank. There are a lot of incentives to ease of doing business. And to those of you who have been following this particular metric, ease of doing business, you would have seen that for the past couple of years, we are not, the World Bank is not mentioning this particular index. So when it was there, the Bank of India was very, especially in some particular sectors like ease of doing business parameters, like contract enforcement, the time taken to give permits. In these particular parameters, India was ranked very low. So that is making a lot of obstacle for foreign investors to come and invest in India. So to do away with all this, the government has actually come up with a lot of rules and regulations, a lot of measures to improve the ease of doing business. That's another major highlight of this particular budget. But one particular area where we didn't touch it in this particular budget was research and development. So in the past couple of budgets, if you see, there was a steady effort to increase the spending on R&D. So we have a goal to increase that from around 1.5% of GDP to 5 to 6%. Our peer countries like say Korea and China or Singapore or Vietnam for that matter, they all have a much higher share in R&D as percent of GDP. So that was one area which I think it was not finally mentioned in this particular budget. This is very important considering that artificial intelligence and new technology in different space, we need a lot of investments for that matter. So this was. That doesn't mean that it never will be discussed. So that's it. It will be scaled down. That the measures on that actually lot of happening. And then there are lot of measures for other areas like manufacturing. That is to increase the share of manufacturing in GDP to 25%. The past couple of years, for the past one decade, the share of manufacturing in our GDP has been constant at 50%. So government has taken a lot of measures. There are announced a lot of measures, including the PLI scheme. And different sectors are also going to be added, specialty steel, specialty chemicals, and so on and so forth. And infrastructure development itself will improve logistics. In fact, cost of logistics has been a huge laggard. It's a lagging feature for India because this particular measure, you see as a percent of GDP, that's a standard way you measure it. For India, it's around 30 to 14% of GDP. For China, it's below 10%, and many of our peer countries are having this measure below 10%. So a lot of measures to improve logistics efficiency. That is also there. Of course, infrastructure investment itself will unlock a lot of differences. So over a course of time, over a period of time, our cost of logistics are also expected to come down. So this is good for the logistics sector. This is good for infrastructure. For small and medium enterprises, there are a lot of sectors. There are a lot of benefits like improving the collateral free loan limit, 10 lakh, 20 lakhs. And RBI has also complemented that by they go yesterday and have come out with guidelines. Their guidelines to direct the banks to increase the collateral free lending to MSMEs from 10 lakhs, 20 lakhs. Then there are measures for promoting agriculture, especially food processing sector. Then to complement the use trade deal, there are a lot of incentives like our fellow panelists mentioned, a lot of incentives for promoting data centers, global capability centers, power reforms, for instance. Now, I don't know whether you have seen this, the Power Finance Corporation and the Rural Electrification Corporations have merged. So that will create a big non-banking financial sector, big PSU, NBFC. They will that will have the wherewithal to fund power sector. And power sector is very important now because data centers are coming. And when data centers are coming, they need power. It's a very key ingredient for the smooth functioning of data center. So power sector, a lot of initiatives. And all these will impact banking sector because that will increase the demand for credit. Now, even now, though India developed financially, the corporate bond market has not developed to the way we want. So I don't know how much of you, how many of you know about corporate bond? It's nothing but a bond, like a government bond. Corporates also raise money by bond, but that market is not developed in India the way we want. So even now, banks are sort of a key player for financing. So we need, so all these sectors will need a lot of funding. Some of the banks, they have to learn how to do due diligence. So for instance, BCCs are a new concept for the banks also. They have to learn how to do due diligence because we don't have past data on these sectors. Without historical data, it's difficult to understand how they perform. So these are some of the challenges for some of the areas where the banking sector also has to be on the learning curve. So on the whole, for the banking sector, what I would say is that this budget, if seen from a long-term perspective, it will help in achieving double-digit growth of credit. Now the bank credit is growing at the rate of 12 to 13%. So we can very well see that in the next couple of years, the rate of growth of bank credit to the economy will be around 13 to 14%, or nearly 15% on an annual basis. So that is something which is very positive. That's why you see shares of banks have gone up. Like State Bank of India for that matter. The last couple of days, they have gone by 10 to 15%, 12%. In this 3 days. So that's what budget has done for the banks. Though in the first 2 days, it was lagging. So because the market takes time to digest what is the final principle. So I think this is what this is how these are all the takeaways from my side. So for the economy and banking sector, for the economy, this aim is to target 8% growth. That is steadily 8% growth. And for the banking sector, the effect is the positive effect is the double digit growth in credit, at least at the rate of 15%. Will be maintained. Of course, the higher bond yield is a little bit drag because the treasury departments will find it difficult to maintain profitability because yields are going up. But unfortunately, most of these treasuries, they have purchased the bonds at the rate of 6.35, 6.40, that's it. And now we are at 6.75. So the yield is high. As I mentioned, the price will go up. So they will see the market loss. So otherwise, on the whole, from a development perspective, now that populist kind of budget, maybe they don't want it because the elections, most of the states they have been, so they don't need a populist budget. And whatever they have done in the past, they have worked well. Now 8% growth every time, despite this tariff issue from the US, which was troubling us a lot. Despite that, in the last couple of quarters, we have consistently posted 7.5% increase. So this budget should take it silently forward without any progress. So thank you. That's it.
Thank you, panelists, for that insightful session. Now we can have the Q&A session. If any student or members in the audience have any query, you may please ask the questions. I request the volunteers to please go around with the mic. Faculty members, do you want to just initiate the discussion? Good afternoon, sir. My name is Shizani. You talked about capex, how if we increase public capex, will increase private investment in the country. So if we see capex of back in 2013-14, it was somewhat around 2 something lakhs here. Now this handling at 12.2 something here. Do you really think capex is increasing private investment, or are we just making up for the low private investments of last year? That is my question.
Can I answer this? Yeah, I don't know. Yeah, in the mindset. Oh, it's open, no, might is not working. Yeah, in fact, a very good question I was expecting this. So over the past decade, right, I guess like from 2 lakh crore, we have gone to 12 lakh crore. But the private capital has not happened. So there are a lot of reasons for this. One reason is that it's not that the private sector is not making. If you see the balance sheets of private sector firms, yes, excluding 8%, excluding banking, financial services and insurance, if you see, the profitability has been not very bad. Even in the past couple of years, they've been okay in the sense. Net profit has grown by 6 to 7%. The revenues have grown at almost double times. Now, what happens typically is, whenever profit is accruing, whenever they're getting profit, there are a lot of stakeholders which have to be satisfied. And the first is the shareholder themselves. What we are seeing is that most of the profits which have been accruing to the corporates, they have gone into rewarding the shareholders. Now, I think it's something which you will be aware in the in the normal course of academics, that if you sit in the boardrooms, I was very participating in boardroom discussions. If you sit in the boardroom, especially if you are in a private property or promoted driven property, what happens is the regular question which happens from the nominee of the shareholder in the board is, why your OPEX is there? So what is OPEX? OPEX is operating expenses. So this is a common question. So the implication is very plain and simple. If a biochemical player posted 1 rupee today, they are interested only in earning 5 times that, 3 4. So that's the only thing. So what is happening is, the profit is accruing. The most of it goes to reward the shareholders. And in the process, the real investment, the fixed investment has taken a hit. So this is one harmful. And then there are other factors also, like the general income levels of the population, especially agriculture sector, has not been going well. The rural demand, if you see, the rural sector has not been doing well. The rural wages, adjusted from inflation, the rural wages have not done well. It has started picking up in the last couple of quarters, but the last so many years, the rural wages adjusted for inflation has not picked up. And the urban sector also, the wage rate adjusted for inflation has not picked up. So this has actually reduced the demand for various commodities, various products. That has also dissuaded the private sector from investing in further capital because there is no demand visibility. So I think this is what comes to my mind when it comes to why private capital has not happened.
Thank you, sir.
You want to add that?
Yeah, we'll go to the next question.
Maybe I'll just add one small point to this comment. A simple example, when China being happened, right, China plus one, India is not the beneficiary of that in major part because we also have a lot of countries like Taiwan and all. Why? Because of the infrastructure. None of the MNCs are very keen to have a manufacturing setup in India because the logistic costs are high, the transport is not there, and also the export hubs are not near. So unless India invests in infrastructure and they are able to give solid platform for them to come here, manufacture. Right now, most of the sectors we are largely assembling the products, not manufacturing at home. So if you don't give importance to capex, the Make in India dream will not come true.
I hope that will answer it very. Any other question? We have Dave here. Yeah.
Good afternoon. We are honored by your presence here, and thank you for the expert discussions. So, as an investor, I want to bring a point of view of the investors in this on this question. First is the fragile infrastructure. Last year, bridge collapsed in Bihar and all over the country. Bridges and even some cracks and all those things. So, is this will this build morale of the investors? Would they be more interested in investing in this country after seeing some mishaps? And the second thing is consistency. In even on Sunday, being it first track, the market was kept open. Investors, especially outside investors, in fact the foreign investors, they like consistency because on Sunday they have a holiday. They don't like to change their schedule for some country and we are not matching with the global standards as per the consistency. Even option expiry dates have been changed recently and the lots of the options specifically. So I'd like to touch upon those two issues very critical for the investors. Maybe, I would say that while you were saying that Sunday the budget was announced, but market actually crashed on Sunday. It recovered on Monday, Tuesday, Wednesday. The maximum money got pulled out by FIIs on Sunday. So, I want just because global functions in a particular manner, I don't want to paint myself in that manner. I would rather have India dominate the world rather than allow global dominate India. Okay, that is first. Second, what I don't know if you're following newspapers, a lot of companies like Flipkart, Zepto, they all moved their holding company from Singapore, US to India. Reserve big. Indian markets are doing that. The kind of valuation Indian markets are giving, even the US market is not able to give. In fact, the US market is stagnant. Having said that, US market is much more mature than Indian market. We are still 3 to 4 years ahead. Now is the time with AI and all coming into picture, the gap can be reduced significantly. The question is India going to take that plunge to be counted as a developed country and be at par with US?
I can see a hand in the last row. Can you introduce yourself and ask the question? Yeah.
My name is Mr. Raja Peacock. My question is, which retirement is more beneficial, the old one or the new one?
Vaccination.
Tax relief. See, there is no standard answer that which regime is better, but if you see from the time it was announced in 2020 budget, as of today, the new regime appears to be better. The reason is that they have lowered the tax rate so much. Actually, now people are forgetting the old regime. Earlier, we used to sit and compare also. From 2020, 21, every year we used to compare. Now, slowly, the time has come when it is wiped off in the mind itself. So people have actually moved on to the new regime. Very rarely you will find very few cases where old regime will be beneficial because the gap is too much in the tax rates. Because there above 10 lakhs itself 30% tax and here above 24 lakhs. So they have created such a big gap. Now most of the people they are not ready to sit back and check also whether the old regime is better. So slowly everyone has moved on to the new regime and they will actually scrap it over a period of time.
Just to answer, just to add to what she said, one layer, if when you're filing your return, if you're going to claim exemption for HRA, if you're going to claim reduction for housing loan, then the old regime may be beneficial, but the government intention is very clear, they want everyone to move to new regime. So it's a matter of time, maybe 2 years, like she said, they may scrap the old regime completely.
Yeah, we'll have the last question. Yeah, from Dr. Shikha. So we can just have a little bit more clarity towards the term orange economy for our students. I think is very helpful because this is how the Union Budget 2026-27 was addressed. So you can just wonder on that.
So the orange economy is actually something which fosters creativity. Right? Yeah, it fosters creativity, it fosters the curiosity, it fosters the innovation spirit. So that's the overriding thing. Now, if you just extend the vibes from the budget, what has happened? Now with the air summit happening in Delhi and all. This is the running thing. That is how we can structure the budget and the revenue expenditure budget in such a way that it creates an orange formula, how it creates a guiding path, a pathway towards innovation, towards focus on research and development, how to improve the education system. Yesterday there's a particular specific focus area in this IS unit itself which is happening really, which deals exclusively with how AI can be used for education. That is done jointly with the Ministry of Electronics and Information Technology and the IT members. So this is the pathway. Fund budget has set a tone for that by giving funds, promoting data centers, asking Amazon and Google and Microsoft to come and set up bases in India, giving lot of reforms on the power sector and taxes simultaneously. So this is all about good fostering creativity so that by 2047 we are going to become at least, I would say at least a $30 trillion economy. That's what it is.
Maybe because we have a bunch of things on maybe one perspective is when the government was everything has a time. For example, there was time for Google and Microsoft. Now the government is looking at who are the next big players. Google, Microsoft are not going to continue forever. There is going to be a new player, and can India produce that? Can the next huge companies come from India? So for example, you had phone is classic BlackBerry. It's now gone. You had Nokia, it's gone. It's a new player. Can India produce that? Then that's what also Amit is.
There was one question, I think he really wants to ask it. This is the last, okay?
So, good afternoon, sir. I am Ashwin. So my question is, as a person, I want to pursue my masters in abroad. So how will this TCS help me out? Is my small question, because you have said that TCS has reduced from 5% to 2%, and how it is going to help is my question is all about.
Suppose if you want to go for foreign education, then suppose if you open a bank loan, then as such TCS is not a cause of concern, there is no TCS. Suppose your cost of education is coming 20 lakhs. 20 lakhs you spend, the government will not keep any lakhs. Suppose if you're putting in your own money. So as such, 10 lakh, up to 10 lakh under the LRS scheme, there is no TCS. Up to 10 lakhs, no TCS. Above 10 lakhs, suppose you have to spend 20. So the next 10 lakh, for a year, 5% extra upfront you have to give, which comes to 50,000. Now instead of 50,000, they have reduced from 5 to 2%. So on an education expense of 20 lakhs, only 20,000 will be. So 30,000 you will save like that. So unnecessarily it used to get blocked, and you could claim it at the time of filing the return. So that 3% saving, but only above 10 lakhs. Suppose if you're spending below 10 lakhs, nothing.
So you're saying that I will get the money back after.
So when you file your return, if you're not liable for tax,
Okay.
then you will get that.
If I not file the ITR
That's the reason.
after a few like.
So you would file your return.
Okay, thank you.
But see, once they deduct tax, you will be forced to file it. That is the logic.
Because why I asked this question is because if I have sorry, so I got to know that this is the amount I want to get, which is the 20,000 from this TCS.
Yes.
But it's after the financial year is what you said. But if this TCS is on 2027, and if I file it on 2030, will I get
No, you-
my ticket again? Only that on the same particular. Yeah, thank you.
Okay, thank you. Yeah, with that we come to the end of this wonderful Q&A session. I now call upon Professor Purnima Gupta, Area Chair Finance, and the one who coordinated this program, to kindly deliver the vote of thanks.
Thank you. Good afternoon once again to all of you. On behalf of IIT College Autonomous, I extend my heartfelt gratitude to all today's panel discussion on the Union Budget 2026-27, a meaningful and enriching experience. First and foremost, we thank our distinguished panelists, Dr. Vinod Vyas, Dr. Madhavan Putiji, TA Vinay Mehta, and CA Shruti Agarwal. Your insights and perspectives have truly deepened our understanding of how fiscal choices shape the future of our economy. We express our thanks to all the delegates who are attending the session offline as well as online. We also express a sincere appreciation to our beloved director, Professor Arun Kumar, for his constant guidance and encouragement. Our principal, Dr. Shakti, Registrar, Dr. Raman, Dean, School of Technology, Dr. Sanju, Assistant Dean, MBA Program, Dr. Vidya, Assistant Dean, Undergraduate Program, Dr. Swamila, Program Chair, Biham, Dr. Gitanjali. Officer Mohammed and Dr. Shikha for their invaluable support. A special thanks to all our faculty members for the involvement and mentorship, and to our student volunteers, especially Samya Sinoni, Apurva, Shivanya, Dr. from all other school categories, whose dedication and teamwork ensure the smooth conduct of today's program. Finally, we thank each one of you in your audience for your active participation of this ceremony. Your presence has added great value to this discussion. Congratulations to the students who attended the session.
Thank you, everyone. And now, that was a formal vote of thanks for the panel discussion. We have another, very momentous occasion here where we are going to, recognize the contribution of the students. Right, so we will start the certificate distribution in some time. I request the volunteers and Dr. Shikha to please come here. For this panel, our students are receiving awards for the contribution that they have made in various fields. And it would be like an honor for all of us to have them receive at your with your hands. Yeah. Thank you so much. Students, please be seated. The first certificate goes to Anani Iza Vinod from MBA. Who's been actively involved in anchoring and dance activities, demonstrating good discipline, positive behavior, and enthusiastic participation in class. I request Mr. Nilay Mehta to kindly hand over the certificate to Anani. Next is Pavitra N from MBA Portsep. Consistently demonstrating good academic performance, maintaining discipline throughout. We have Sneha C. I request Sneha C from MBA PGCT. Please come and receive a certificate. Besides academic engagement, she is also good with cultural activities. Prathamesh Balram from MBA, class representative, maintaining good behavior. Gautam Rawat, MBA. And Miss Upep and Miss Pressure of this year. Shantanu Kayat, MBA. Winner of many intercollegiate events. Sri Lakshmi, MBA. Mohammed Anas, MBA. Bhuvaneshwari, MBA. Saujanya, MBA. Saujanya is the happiness secretary and Bhuvaneshwari has been part of the LIFE project. Now we move on to the BCom students, Ms. Husna Taj. Outstanding academic performance, Asliyan Ata, and part of various sessions, orientation sessions. Mr. Bhuvanesh Chandran, student council member and has contributed in the sports activities in the college. Ms. Pratisha, champion sports person and winner of state and national level tournaments. Ms. Niharika, active participant in cultural participation. Ms. Anvesha, known for research aptitudes. Ms. Shweta, creativity and skill development is our forte. The PBA achievers, Ms. Kartika, General Secretary. All rounder and very good with cultural, sports. And right attitude. Mr. Nakala Ravan. Financing Secretary. Good with research paper has presented at various IIMs and IITs. I request the principal to please do the honors with the guests. Ms. Shweta Shekhar and Inaya. They presented a research paper in IIM Nagpur under the guidance of Dr. Frederick Rubin. Ms. Sanahat is the current General Secretary, displaying leadership skills, hosted podcast with Guru Practice, and is the editorial board member of Catalyst. Ms. Rudrani BBA, One Brand Bangalore, and has represented the college at various events, Sparkle Finance Club, Global Cultural and Academics. Has co-authored a research paper for IIM Bulgaria with Dr. Gitanjali. Ms. Jayashree from BBA. She's been editorial member of Catalyst, class coordinator, explain good leadership and team skills. Aditi P. Rao. Very active student. Mr. Karthik Joshi. Member of Catalyst and the Novel Ganga. Chetan Gaura. We still have more students. Mr. Urman Aras. Naga Tushar. From BCA. Mr. Vinarma Jaikaran, BCA. Maitri Amarita. Ms. B. Srilakshmi. Ms. Meenu Kumari. Ms. Pavitra. Mr. Hari Prasad. Mr. Indran Sir. Ms. Jagruti Reddy. Ms. Arya Pandey. Mr. Mohammed Abuzar. Ms. Panchami. Ms. Anwar Singh. Mr. Deepak. Ms. Deena Gataya and Mr. Jeevan Kumar. The students of School of Technology who have been contributing actively towards running the IT clubs. They're good with sports, academics, they're all rounders. Jeevan Kumar, is there? Thank you so much. Congratulations, students, and keep up the good work. I now request the director and principal to please thank the panelists with a token of appreciation. Request Dr. Shaktivel sir and Dr. Arun Kumar to kindly give away the token of appreciation. I would like to once again thank Professor Vinod Vesalo. I request the director to please hand over the token of appreciation to him. Dr. G. Madhavan Kuti, I request Dr. Shaktivel to please hand over the token of appreciation. Mr. C.A. Nilay Mehta, I request the director to please hand over the token of appreciation. And Ms. Shruti Agarwal, request Dr. Shaktivel to please hand over. Then we come to the end of the session. I hope all of you had a fruitful session and some insights were brought to you. Request the students to please be seated till the panel leaves. Thank you, panel. Volunteers, please usher the panel. Yeah, let us organize for a group pick. Faculty members.
मानव टेबल थोड़ा
Okay, ma'am. ಪರವಾಗಿಲ್ಲ ಹೋಗಿ
Yeah, we have to look at one.
Dean also.
We have to give the rest in them, but what about morning?
No, no. Then I, these people said not because I was too. Okay, but